Well, good morning, everyone. Thank you very much for joining us today. So, as I said, the event is recorded and we can share a copy afterwards as well. It'd be nice if you have your cameras on if you can, so that we can see you, but do keep the microphone muted until after the presentation, please. If you do have any questions throughout the presentations, don't hesitate just to pop your hand up. Dan is very happy to take those as they come along rather than waiting until the end. Plus, we've got that Q&A slot afterwards as well. We will be monitoring the chat, so if you do want to pop anything in there, please do so. And if you'd like to share your contact details with fellow Make UK members as well on the call, do so, and then you can always connect after. Before we go into Dan's presentation, we'll have a quick poll just to check out which way you are currently buying your energy. So we'll give Dan a good idea of the audience today. So we'll launch that poll. Can everybody see that? Okay, and I think the other three are probably us and Brigitte. So there we go, Dan.
Interesting. I'm glad that the numbers have actually looked that way. 79% of people are currently purchasing their energy through fixed price contracts. For the 21% of you that are flexible, might be a little bit sucking eggs today, but hopefully we can provide a bit more additional information around green options, which you may not have considered. But yeah, as Annette said, welcome any questions throughout. I'll start sharing my screen if that's okay.
Yeah. Right.
We all good?
Yeah, I can see that.
Excellent. So thanks everyone for joining this morning. As Annette said, it is recorded so people can watch it as and when and dip back if anything is a little confusing, and welcome questions throughout. We do have a dedicated section at the end for Q&A, but welcome people to chuck their hand up and jump in as and when. Briefly go through the agenda for today. Hopefully I'm going to help everyone understand the energy markets and clear up any untruths that you maybe some misconceptions, or maybe that you've been told by people. Give you an update on the energy market, which I'm sure everyone wants to hear about and has probably felt some pain recently if you've been through your renewal cycle. I want to talk about what options are available, particularly for Make UK members, around risk management and how you can start maybe looking at different ways of purchasing energy in the future. And also go through some green options, particularly solar. So wanted to put that on the agenda and talk through how some of our clients have been benefiting from solar at the moment, both funded and the capex. And then we'll cover questions at the end. So I'll jump straight in. Starting off with demystifying the markets, I wanted to cover some common misconceptions that we hear when speaking to our clients and Make UK members. One being that the more you buy, the cheaper the price you'll get. It's not necessarily correct, as we're purchasing a commodity, electricity or gas. The volume that you purchase doesn't necessarily mean that you will, if you use a lot more, that you'll get a better price. If you go to market in the same way as someone who uses 10 times more energy than you on the same day, you're still purchasing the same season of energy, then the prices are likely to be very similar. So it doesn't necessarily matter how much you're buying as to your price. It's more about your approach and of course timing, which we'll cover in the market session. Looking behind your invoice, and I guess looking behind what the energy suppliers do when you request a price, typically on fixed price contracts. For those of you that are on flexible agreements, you might be familiar with some of the terminology I'm going to use. But breaking down future purchasing of energy, you can buy energy essentially in lots of different granular blocks. So starting on the left hand side, hopefully you might be able to see my mouse wiggling. You can buy energy within the day that you're using it. You can buy it the day ahead of when you need to use it, the balance of the week or the balance of the month. If you then move slightly less granular, you can buy individual blocks of consumption for months of when you're going to use it. And just to be clear, you can't use October 22 prices in October 23. So you have to buy the season or the block of energy that you're going to consume and consume it in that period. You can then go out to quarters. So aggregating those months into 3-month blocks, and then further out still is seasons. Now, the importance of showing you this, I guess, is that the further out you look and the less granular you go, there's a lot more sentiment built into those prices because there's anticipation of what could happen. But we're essentially looking at futures, the futures market. So there's a lot of sentiment. There can be risk premiums added into the prices. However, a bit like throwing a pebble in a pond, if something happens today, that could have a real big impact on the prices for spot or even the future months or quarters. But if that information is a short-term fact or a short-term impact, it's going to have very little impact on the future seasons. So I guess the analogy of throwing a pebble in the pond, the closer to the pebble you are, the bigger the impact. And as those ripples move out further, it has less impact. So when it comes to energy purchasing, if you're trying to reduce risk and reduce volatility, purchasing in big blocks, seasons in advance, is typically less risky than purchasing within month or within day. And we'll go on to the markets shortly to show the pricing and the differences there. Going through how your bill's broken out. So on the left hand side, we've got electricity. On the right hand side, we've got gas. I did have some percentages apportioned for this. But due to what's happened in the market quite recently, the percentages are way out. So if we roll the clock back maybe 12, 24 months on electricity, the commodity used to only stand for about 40% of the delivered bill. A little bit different now. You've then got transportation and distribution costs, which are essentially the cost to supply the energy through the grid, the high voltage network, and then your local distribution network. There are taxes and levies applied by government, such as the renewable obligation tax, contract for difference, which all subsidise future renewable technologies. And then there's a climate change levy, which you might be familiar with if you've got a climate change agreement or you're in a mineral or metallurgical industry and you're currently claiming relief of that particular line item. And then you've got supplier and metering costs, which stand for very little of your overall delivered bill. Picture's reasonably similar with gas, although we refer to all of these non-energy costs as non-commodity costs. And the non-commodity costs on gas are much less as a percentage of the overall delivered cost. Now, if we were talking about fixed price tendering and we were going to market today as an example, and we went out to 25 or 30 different suppliers, they're all looking at the same market. So the pricing between each supplier or their view of the market is going to be very similar. So for want of the explanation, the commodity price element is going to be the same for every 25 or 30 suppliers. They've then all got to push that through the same part of the grid to get to your meter. So they all have to pay the same transportation and distribution costs. They then all have to abide by the taxes and levies that are pushed onto them by government. So that element of the bill is exactly the same. And for most part, the metering costs are very similar between suppliers as well. So what I'm trying to say is if we were running this tender today, for example, this hypothetical tender, and we got back 25 different prices, the only bit we're really having any influence on is the margin. And of the overall bill, it's a very small percentage of what you actually pay. So tendering and placing contracts on a fixed basis, forgetting risk in the market and volatility and price movement, the only bit you're really able to impact is a very small percentage of your bill. Whereas the market, being a very big percentage of your bill nowadays, has you get much more success or much more return by focusing on the timing of when you go to market or the method in which you go to market. Hopefully that's quite clear for everyone. Jumping into the markets, we're going to have a look at what's happened. Pretty unpleasant sights in graph format. So first of all, we're going to look at electricity. So on the left-hand side, we've got the prices of wholesale electricity only, so that commodity part of your bill, and these are displayed in pounds per megawatt. To simply move this into pence per kilowatt, which most people are probably familiar with, we're simply just moving this decimal place one place over. So 430 becomes 43 pence. Now from 2007 to 2020, the market, although at the time where we had price increases around 2008 and again in later 2018, we thought at the time they were extreme price spikes. But you can certainly see from what's happened since the start of the pandemic and where we are today, those little blips were absolutely nothing in the grand scheme of things. And we're now seeing prices that we've never seen in the market and didn't expect to see in the market. Now this chart shows the rolling 12-month prices. So for example, if we're talking about it today, it would be say an October start contract for the next 12 months. Now the market's hovered previously around the £50 a megawatt mark, so 5 pence a kilowatt for electricity, and you're probably familiar with unit rates of anywhere from 10 to 15 or even 20 pence a unit. That picture is extremely different today, and we've seen prices quite recent on fixed price contracts as high as 70p, and we've heard of one occasion where a supplier presented a price that was over £1 per kilowatt for electricity, which is just absurd and unheard of. Now, I guess the reason we want to display this, other than to tell people what's happened in the market and how volatile it is that for a very long time, a basic energy procurement strategy has always delivered an okay result, because if you say fix your contracts every 12 months, if you just look at every 12-month period on this chart, you've had reasonable stability in the grand scheme of things. Certainly between 2011 and 2016, if you renewed every 12 months, you likely saw a discount every time. You'd see a price reduction every time you went to market. Then from 2016 to 2018, you may have seen an increase each time that you went to market, but that increase in the grand scheme of things was relatively small. However, for anyone particularly that took advantage of the market lows back in March, April 2020 during the first lockdown, where market prices were £26 a megawatt, so 2.6 pence per kilowatt, and are now coming up for renewal for the end of September this year, are seeing extortionate price increases, going from the likes of that 3 pence a kilowatt right up to 53 pence a kilowatt, which is absurd, particularly for manufacturing, where energy costs can be part of a raw material essentially, but one of the largest operating costs for your sector. The picture for gas is extremely similar. The gas is traded in pence per therm, so you have to do a quick calculation to convert that back into pence per kilowatt. But just to try and make life easier and explain, everyone's probably familiar with delivered rates of gas of around 2 to 3 pence a unit. We're now seeing delivered rates of certainly higher than 10 pence a unit, in some cases 15 or 20 pence a unit for gas, which back a couple of years that was a reasonably expensive electricity price. So it's now getting really expensive to burn these fossil fuels in gas, and again, manufacturing sector, a lot of you will use gas as part of your production process, so it's going to get extremely expensive if you're exposed to this volatility. And the reason the markets look or the pictures look very similar for gas and electric, the UK are a net importer of gas. We have very little storage in the UK of gas, and we don't really extract that much ourselves. So we're heavily reliant on purchasing gas from Europe, and we also receive liquefied natural gas on the back of cargo ships. Now in the UK currently our generation mix is around 40% of our electricity comes from gas. So if gas prices spike and we're using gas to turn it into electricity, that has a negative impact then on the cost of generation, and therefore the cost of electricity will follow gas quite closely linked. So any price spikes in gas, generally we see that same ripple in the electricity markets. Try and simplify those markets. We've put it into a chart. So from 2012 to 2017, the pence per kilowatt average was around 4.7p. The maximum price that we saw in that time period was 5.47, and the minimum was 3.3. So the spread in price, or the differential, was 2p. So buying on a fixed price contract, for argument's sake, the worst you could have got is 5.5p. The best you could have got is just over 3p, and that swing in price was reasonably substantial as a percentage, but in the grand scheme of things, 2p's not a bad increase. I'm sure most people would happily accept that now rather than what we're seeing. Picture was very similar from 2017 to 2020, although the maximum price did creep up a little bit. The minimum was very similar, but in the last 2 years, these price changes are extortionate compared to what we've seen in the previous 5-10 years. We've seen maximums of 62p and minimums of 2p. That's a swinging price for electricity of nearly 60 pence a unit, and that's for a 12-month fixed price contract. And the same picture, unfortunately, with gas, although it's a bit more volatile. Again, this is in pence per therms. I think the equation is to divide it by 27.001. I'm not that quick with mental arithmetic, but just looking at the spread in price there, the spreads in price are extortionate again from 2020 to 2022. So what does this mean? Well, if you're a buyer of energy and you're going to market, timing is absolutely everything. If your chosen method of purchasing is fixed, if you fix at the low point, great, you've done a fantastic job. If you're now exposed to these high prices, it's not to say you've not done a good job. It's just a case of you're stuck between a rock and a hard place now. Your renewal could be due October this year or even October next year. And you're exposed to this massive price increase. Now, in previous market conditions, fixed price contracts have always been seen as quite a low risk strategy and a low risk approach to buying energy, because you know what the price is before you sign it. You guarantee that price for the fixed period, and that then suits budgeting, and you know what your numbers are. However, in an extremely volatile market, a fixed price contract is probably one of the riskiest strategies that you can look at, particularly if you're fixing for long periods of time, because should the market fall suddenly and you've then fixed your price at the market high, you're then left exposed to all of that increase. You're stuck at that rate, and particularly if you're in a competitive market space and some of your competition have actually took benefit of those lower prices, your operating costs are going to be a lot higher than theirs. So moving on to potential new options for energy buying, which some of you, 21% of you on the call are already taking benefit from. But for the majority, we wanted to, brief you on what options are out there and how they might be more suitable for your future purchasing strategies. So when you're looking at energy buying, we tend to approach it as a case of what you're trying to achieve. On one hand, most people will want to get the best price they can, and a lot of customers also want some budget certainty. Now, on a fixed price contract, you are certainly getting budget certainty. You're not always going to be getting the best price unless you're really lucky and you fix at a low point in the market. And sometimes it can be quite hard to have your cake and eat it. So if you want the best price, typically you need to be quite aggressive with how you purchase, have quite a lot of exposure, particularly if the market's in a decline or a falling position, having a contract that allows you to buy very small blocks of energy close to the point of when you're going to use it, or close to the point of delivery, as we use the term, will give you that best price. However, if the market suddenly spikes, you're then exposed to that. You're going to see a substantial increase. Now, trying to get a balance of both is particularly important. And when we go to market, there's a lot of information that can help you make your decision. The way we look at it, we look at two key areas. We look at fundamentals, which are supply and demand. So how's that driving prices? Look at geopolitical issues. We'll look at general sentiment, things like weather. We look at where the liquefied natural gas cargoes are coming and what the expectations are for that injection into our system. And then the technical is more of the, I guess, trading mathematics. So looking at support lines, you may have heard of things like Fibonacci retracement or moving convergence and divergence. So real clever calculations that traders of any commodity would look at. And some of you may actually use that when purchasing your raw materials if you're purchasing commodities. Now, everyone is familiar with fixed, as we've already covered. The benefits of fixed are that you know what your costs are at the point that you sign your contract. Although we have seen some.
Dan,
Yeah.
sorry to interrupt. We've got a question from Anne.
Yeah, fire away.
When you buy packets of energy, for example, for a whole quarter, is there a general expectation that this is for higher usage companies? If so, what would be the usage level before we should be considering buying packets?
Okay. So first part of the question, if you buy more granular blocks, so quarters or months, is that for larger energy users? In the past, yes, it has been. One thing we've had in operation at Inspired for since 2016, I think now, our energy portfolios. So we group lots of small customers together to create essentially a big customer, and that gives all of those small customers then access to flexible trading. So in the past, the answer was yes, but currently the answer is no. So despite you maybe being a smaller energy user and not the Jaguar Land Rovers or the OEMs of the membership, you can still gain access to flexible trading strategies. Annette, forgive me, I've forgotten the second part of the question.
So if so, what would be the usage level before we should be considering buying packets?
So there's no real lower threshold, particularly with our portfolios, the way we've grouped our customers together. So we've got possibly 800 customers across different portfolios, and we group them together based on their appetite for risk and what they're trying to achieve out of their procurement strategy. And we have a few set defined strategies, one of which I'll be talking through shortly. So yeah, you don't really have a lower threshold for consumption. A lot of it will just come down to your appetite for risk and what you're trying to achieve out of your contracts. Mm-hmm. Hopefully that answers the question.
Yeah, does that answer the question, Anne?
Yes, that's great. Thank you very much.
Brilliant.
No problem. So yeah, just coming back onto fixed, everyone's familiar with fixed. I don't really need to labour this point. The fixed price contract approach is great when the market's reasonably stable. You're going to see very little price movement at each renewal when the market's stable. It's reasonably low risk at that point if the market's stable, but what we're seeing at the moment, the market's very unstable, and therefore that becomes a very high risk strategy. The way I try and explain it to people, making it relatable to home, if you were renewing your mortgage, let's say, and the interest rates were at a never seen before high, that I think the last thing you'd be looking to do is go fixing that for a long period of time. You'd probably take a short-term view and hope that things settle. It's a reasonably similar approach with energy purchasing. The other downside that is probably not overly people aren't made overly aware of is that when you're choosing a fixed price contract, there's quite a lot of premium built into the price, and that's mainly because the suppliers. I guess there's two parts of this premium. The suppliers will take a view on the market and what they think will happen in the future. And if you're signing a fixed price contract on a particular day, that doesn't necessarily mean that the supplier is going to go out and buy that volume for you at that particular time, at that particular price. What the supplier is going to do is try and hedge their bets after they've given you a guaranteed cost to try and manipulate the markets and try and get further benefit. So there is, in a volatile market space, there's always going to be a lot of margin and risk premium built into fixed price contracts, because the suppliers are, quite worried about what could happen with pricing. And if they're particularly going to go speculating after they've given you a fixed cost for a set period of time, they don't want to end up out of pocket. The other side of the risk premium is the fact that the market can move quite suddenly within day. So if you're requesting a price from a supplier on a given day, and you need, let's say, 24, 48 hours to make a decision on that price, the supplier has to build up enough risk into the price that when they release the offers to you, you've got the time to make that decision. But there's enough margin or enough fat in that price that if the market was to jump suddenly, if you sign and return that contract, they can still accept that. Now, if anyone's been through this renewal cycle recently, you've probably been extremely frustrated with the number of times that suppliers have pulled prices. And it may be a case that by the time the offers are received in your inbox, the supplier may already be notifying you saying that that offer's no longer valid, the market's moved too much, and we can't then keep that price. And that's because the market's moved more than the margin that they've built in. Now that's quite a tricky position to be in for a supplier, because when people like Inspired are running tenders, all of the suppliers are aware that we're going out to a number of them, and therefore they want to be as competitive as possible to try and secure your business. And the only way they're going to do that is reducing their margins, but also trying to be really clever with how much risk premium they build into that price. And therefore, the lower the risk premium, typically the less amount of time you get then to make a decision, particularly if the markets are moving quickly. Moving on to a risk managed example. So with risk management and energy purchasing on a flexible basis, it doesn't necessarily mean that your price will change all throughout your contract. There are methodologies and strategies that allow you to pre-buy your energy before you need it. So we call that the delivery start date. So for this description, let's say this line here is October 2023, and we're here today. On a fixed approach, you might renew your contract today, and you've fixed out at that point in the market. However, on a flexible and risk managed strategy, particularly if you're buying before the point of delivery, so before your start date, what it allows you to do is spread the risk over that period or that trading window. So between now and October next year, we can make multiple purchases over that period, trying to identify the low points in the market. Of course, marketing have made this slide, so we've pretty much picked the low points there. But generally, the flexible approach will outperform a fixed price contract in nearly every situation. And that's because you're spreading the risk, so you can buy different amounts. You might make hedges if people are familiar with that term. So you might buy 20% of next year's consumption at this point, and then another 20% there, and maybe 30% there, depending on what's happening in the market. But versus a fixed price contract, yes, this fixed price contract example here wasn't at the top of the market, but it certainly wasn't at the bottom. Whereas a flexible arrangement will still be able to take value out of the market when it's volatile, particularly focus on trying to be towards the lower end of the market. Now, some flexible strategies allow you to buy after the point of delivery or within the delivery period, and that's where the granular blocks are day ahead or maybe month ahead. So you're securing the price for let's say September this month, and then you might be securing the price for October in this month or next month. So you can, by doing that, you're a lot more exposed to what's happening in the market. If something happens or an announcement occurs today that's going to impact next month's pricing, then you're exposed to that if you've not took cover. Hopefully everyone understands my explanation there. I'm sure in that you'll be vetting any hands up, so if there are any questions, please feel free to throw them over. Now, just going to play a scenario of a particular strategy that we employ for our portfolios. And these portfolios, as I said before, where we group lots of smaller customers into a basket or a collective, as some people might refer to it. And we then trade them a bit like a hedge fund, really, with investment on a predetermined strategy. We have high risk strategies that allow people to potentially get the best price in the market, but with that comes a lot of risk because you're generally buying within the period of delivery or very close to the point of delivery, which is higher risk, or lower risk and better for budget, what we refer to as our guard strategy, where you're purchasing blocks of energy in advance of when you need to use them. So on this chart, we've got time across the bottom, wholesale price up the left-hand side. I wish these numbers were more like today, but unfortunately the prices are a lot more. In this scenario, we've labeled a 36-month fixed price contract, today. However, if we look at how this strategy would play out, we've got a trading window between today and when that contract starts. So say again, for scenario purposes, that this contract starts October 23. We've got nearly just over a 12-month trading window before the contract for year one starts, so October 23 to September 24. What we can do then is purchase your volume for next year over a number of different trades, and these percentages here.
We've got another question.
Yep, fire away.
If there are no foreseeable dips in the market, is a flexible arrangement appropriate?
Yes. So there's always going to be up and down movement, even if the general direction is up. So for example, if we look at, if I draw an imaginary line on here to here, despite the market being in a general upward trajectory, there's still opportunities to purchase at lower prices than there, for example. Well, the idea with flexible strategies is not designed to be deployed in necessarily a falling market. The idea is that you're managing the risk of it going up by taking hedges in future periods without having to commit. So on a fixed price contract, if you want to protect yourself, you have to commit for the period that you want to protect yourself for, and you commit all of that. So on a 36-month contract, you're buying 3 years worth of energy on one day. Now, I guess trying to explain that in an analogy, if you walked into a casino and there was a roulette table with 365 spaces on it, or on a 3-year contract, nearly 1,000 spaces on it, and you spend £100,000 a year, you're putting £100,000 chip on one particular point in time. That's a hell of a risk to take if you're not certain that that's the right point. And then I guess many people will be in this situation now. If you see a price at a particular point and you're unsure whether to take that because you're making a 3-year commitment based on one particular day, it's extremely risky. So flexible contracts will work in a rising and a falling market. There will always be up and down movements despite the general direction going up. But with flexible strategies, the benefit, particularly in rising markets, is that you can look out further without having to make those commitments. So if I play this scenario through, a 36-month fixed price contract, you've bought all 3 years worth of energy at one particular point ahead of when your contract starts, and that's the price you get. On a flexible strategy, we can still cover 3 years, so you get 3 one-year contracts effectively, and for each contract period or delivery period, you will achieve a fixed price because we've bought all of the energy before that contract starts. Analogy, again, to try and explain that, I guess if you're going on holiday to France and you're going in the car, a fixed price strategy would be, so you're trying to get your fuel the cheapest price you can get for that journey. A fixed price strategy is you go to the fuel station on a particular day when you think the time's right and you fill that car, and then you know what your cost is for that journey. A flexible strategy, say for example you've got a tanker at home, you might go to the fuel station every day over the period of a month and buy a little bit, and the average of the prices that you've achieved then is the price that you get for that journey. hopefully that analogy explains how it works. So with the flexible strategies, you buy into the future. So for argument's sake, based on today, we can secure prices out as far as 2027. Now, on a fixed strategy, securing prices 5 years out, they come at a massive premium. Whereas on a flexible strategy, because you're purchasing wholesale, there's no additional risk premiums from the suppliers. We can see what the price of the market is, and therefore we can secure it at that price. We're not then reliant on the supplier adding additional premiums to those numbers. Hopefully that makes sense. Have I answered the question whilst, I guess, finishing my slide as well? You have to forgive me because I can't see any heads on here. I'm only on one screen, so I can only see what you guys can see.
Yeah, no, the message from Anne has come. Yes, thank you.
No problem. So hopefully I've explained there how a flexible strategy will still allow you to achieve fixed prices, but certainly a lot less risk because you're spreading that risk over a number of trades. I know this slide's a bit messy, but the delivery period year one is pink. So these percentages refer to the amount of volume that's been hedged. So at 100%, by that point, we've effectively bought all of the energy that you need to use for that delivery period. Delivery period 2 is light blue. So we can start trading for delivery period 2 now, and we can take cover over those periods. And as long as we've bought all of the energy that you need for delivery period 2 before that contract starts, you'll achieve a fixed price for that supply period. And the same applies then for delivery period 3. So we can start purchasing delivery period 3 now, if the market was favorable to do so, and providing we've taken enough positions and hedged 100% by the point that that contract starts, you've then achieved a fixed price for that period. And the horizon can change. So particularly with electricity, we refer to it as liquidity in the market. So if there's liquidity, that means there's offers or prices available for people to secure. Typically with electricity, you're looking for 3 to 4 years, generally with favorable pricing. With gas, the horizon can be much further, 5 or 6 years. Hopefully that explains that. Before I talk about green options, is there any more questions around flexible energy buying? I know there's a fair bit of information to take on here, and I'm trying my hardest to not throw a load of jargon at everyone.
Yeah, there's something else that's come in. So we've got a couple here. So one, do you operate your flex strategy for smaller usage customers as well?
Yep. So there's no tolerance on our flexible strategies. For the smaller customers, we do have 2 strategies available. One which we refer to as guard, which means we buy all of the energy before your contracts start for each delivery period. So you achieve a fixed price, which is good for budget and lower risk than fixed. And we also have a strategy that we refer to as buyer, not very imaginative, but the buyer strategy is designed to be bought within the period of delivery. So higher risk, but generally will outturn a better price for the customer.
Okay, and then there's, apologies if I missed it, but can you resell percentage chunks for new lower price dips?
Yes. So the beauty of flexible, yeah, good point. I'm glad someone's asked that because I've clearly missed that point. One of the beauties of flexible energy purchasing is that you can not only purchase, but you can also sell back. So for scenario's sake, you might buy your energy at £30 a megawatt and we hedge 100%. The market increases to £90 a megawatt. And then all of the indicators and the fundamental and technical analysis I mentioned earlier signal that the market's going to decrease. What you can do, and I'll explain the risk behind this, is sell that hedge that you secured at £30 a megawatt back to the market when it's at £90 a megawatt. You're then exposed to the market at £90 a megawatt. If the market falls then to 70 and you re-secure your volume at 70, you've made I guess a profit of the 30 to 90. So you've made a profit of 60 and you've secured at 70. So you effectively achieved a price of £10 a megawatt. That's an extremely I've used numbers that probably aren't realistic there, but just to try and explain the scenario. Now, the risk in sellbacks is that if you sell your energy back to the market at that particular point because you feel, or we feel, that the market's going to turn and fall, you're essentially re-exposing your volume to the pricing. So you've then got no coverage. You don't have to sell all of it back. You can sell a small percentage in some cases, but at the point that you re-expose that volume, you're re-exposed to the market. If the market doesn't fall, as indicated, and actually increases, then if you don't have the time between that point and your contract starting, you're then repurchasing that hedge in an inflated market, which could end up being detrimental to your price. So some people see it as quite a high risk strategy, re-exposing, unlocking, sell back, however you want to refer to it. But it is in the tool bag, let's say. So it is a methodology that's available, but you have to do it. You have to consider the risk of re-exposing that volume at that point.
Okay.
Hopefully that's answered the question.
We've got a couple more here as well. So we've always been on FPC for flexible strategies. Are these managed by yourselves, or would we have to manage our own purchasing?
Say that again, sorry.
So this member has always been on FPC, flexible strategies. Are these managed by yourselves, or would they need to manage their own purchasing? Can you support with that? Okay.
So FPC is fixed price contracts, I'm guessing.
Yeah.
Flexible contracts, you can. So the way a flexible contract works is essentially we have visibility of the market and we get access to the screen prices that the suppliers will see. You appoint a supplier that is going to be your nominated supplier for the period. And anytime we then want to make a trade, we essentially call that supplier up and say, we've seen October 23 at this price, we want to secure 50% of the volume at that price. And sometimes they negotiate a little bit, but typically we'll secure it at that screen price. So it's the supplier that's supplying the contract, we act as the buyer. Now, with smaller customers that join the portfolio, what we tend to do is pre-agree a strategy and pre-agree some parameters that they're comfortable for us to work within, and we will then execute that strategy and just report back to the customer to say this is what we've secured, and we've agreed those parameters in advance so that the customer's comfortable of us working within those set parameters. For some of our larger customers where they're on a standalone contract that's flexible, what they may choose to do is actually be the decision maker of when they buy, and they then use Inspired and our trading desk to give them the information, the analysis, and execute the trades. But essentially we have to go to them and say the price is this is our recommendation, what do you want to do? But typically I would say a standalone flex contract, you generally have to use 7-8 million kilowatts of electric, probably similar of gas, to make it viable to do so. And that's because on a standalone contract, with any flex trading, you get certain clip sizes or amounts you can secure. So how can I explain this? If you've got £1 to spend, your clip size could be 250p's, it could be 520p's, it could be 1010p's. You get the gist. 25p chunks. So if you've got a reasonably small volume on a standalone flex contract, you may not get the ability to make lots of trades, because you may not have a small enough clip size to spread your volume over those number of purchases. So then what inevitably can end up happening is a flexible contract. If you've got a low volume, you might only get 2 purchases within that trading period. Whereas in a portfolio, all of that volume's aggregated, so we can make as many trades as we want, providing the volumes in the portfolio, which it is with ours. So it gives you a lot more flexibility to make those purchases. Has that answered the question?
Does that make sense, Sam? Yes, answered, he says. And then the last question for now. Our current fixed deal expires in October 2022. Is the window too short for us to explore a flexible option?
Yes. currently. The practicalities of a flex contract is that you need a trading window to have the ability to try and play the market and spread your purchases over a period. If you've got between 6 weeks before your renewal starts, the practicality of running a tender, appointing a supplier, then going to market, you may only have 4 weeks worth of trading time. If the market's in an upward direction and all of the signals are saying it's going to continue to increase, which is the current outlook, then our traders' job is to manage that risk and protect you from that increase. So they would inevitably just fix out 100%. That answer is if you would be going in a guard strategy where it's bought before the point of delivery. If you've got an October 22 renewal and you're happy to take more risk and want to buy within the period of delivery, then no, you can join that anytime, because you're not having to pre-buy before the point of the contract starting. Now, I'm not saying that if that's your scenario, you've left it too late to join, because you can still benefit from that risk management for next year, the year after, the year after. But if you were to join the portfolio now, then you've got 12 months trading window for next year, 24 months trading window for the year after. But the year one contract would look very similar to a fixed price contract for all intents and purposes, because it's likely that we just make one trade, protect that position based on what's happening in the market at the moment. Hopefully that answers the question.
Yeah, it does. Thank you. And
no problem.
For anybody, Dan is of course available for individual follow-up conversations as well. So if you want to go into any detail. Right, I think that's it for now for the questions. So over to the next chapter.
So it's not all doom and gloom. There are green options. So for any of you that have joined our previous webinars, the general messaging is around net zero and helping people to try and understand their carbon footprint and reduce it. And of course, people may have already taken options to look at generating their own renewable energy. And for today's topic, I'm particularly focusing on solar, particularly because the paybacks are very good at the moment. Now, green options can also be a way of managing risk in the market by generating your own energy renewably on your roof. Not only do you receive a carbon benefit for that, i.e. you reduce your carbon footprint, you also reduce your exposure to the market. So if you're generating it on your roof, it doesn't matter if the market moves up and down, because you're not exposed to that. So a couple of options available for people's disposal. With solar, you've got a capex option where you can invest yourself, put it on your roof, and you benefit from all the energy that you generate. The way we've modeled this, and certainly with proposals that we've released in the last 6 months, we've seen some paybacks as low as 2.1 years. So really quick return on investment. And when you model that investment over a 25-year lifespan, which is typical for solar, if you reverse engineer the numbers, it's essentially working out that you're securing the energy that's generated on your roof at 4 pence a kilowatt. Our current wholesale cost of energy is what, 65 pence a kilowatt. So that's a great number to, I guess, or a great prospect to look at. And appreciating with the cost increases, not only in energy, but everything else and all the other challenges that we're facing at the moment, people may not have disposable income or money available to deploy on these types of projects. Banks are extremely, they're favouring green and low carbon technology at the moment and low carbon investment. The way banks are securing their finance from investment pots, these investment pots are particularly focused in investing their money in low carbon technology and low carbon projects. And therefore, if you were to go to your bank or a bank and request a loan for solar, you would typically get a lower interest rate than you would for, say, a gas boiler, just for example. And that's because the banks have set their own net zero targets, and part of those net zero targets from the banks are to reduce the amount of investment in fossil fuels and increase the amount of investment that they have in carbon. when the banks account for their own carbon footprint within scope 3, which you might be familiar with from previous sessions that we've held, the investments that they make, it actually comes into their carbon footprint. So if the banks are going to invest in a gas-powered electricity generation station, for example, all of the carbon emitted from that power station then comes into their scope 3, which looks like a bad picture on their overall carbon footprint. If they're investing in solar generation or renewable technology or lower carbon investments, that looks a lot better on their own carbon footprint. You're probably all aware as well that the super tax deduction remains in place until March 23, I think it is. There are talks that could be extended. I know Make UK are quite actively following any updates on that. But you know, solar's got a great payback for capital investment, and you're going to get that tax deduction as well. And I think it's year 1 of the purchase. Now, the other option, so if you don't have the money sat in the bank and you don't want to go to the bank and request the money to secure a loan to look at solar yourself, there is a funded option or a power purchase agreement. And essentially, in this scenario, what you're doing is you're allowing an investor to purchase solar, put it on your roof, and then sell you the electricity that's generated on your roof to you at a fixed cost over a set period of time. Now, the advantage of this is that you don't have the capital outlay, so you're not putting your hand in your pocket and spending your own money. The prices that you secure with the investor for the solar that they put on your roof are not index linked to the wholesale cost of energy. So you're not then exposed to that volatility, and the prices that you secure aren't linked to that volatile market. The prices you secure are linked to the investment that's made. And you typically get a fixed cost over 10, 15, 20, 25 years. And those fixed costs will be open to inflation, but RPI is much lower than the volatility in the wholesale market, as we've seen on previous slides. So a lot less risky. We're currently seeing rates offered to customers on power purchase agreements of around 11 pence a kilowatt for 10, 15, 20 years. So these are fixed costs, which you can't get those rates in the market at the moment, just buying it off the wholesale market. Now there are some, I guess, drawbacks to PPAs and funded solar options. There's generally a minimum size that people would look at, and that's 100 kilowatt of installed capacity, which would generate around 80,000 kilowatts a year of electricity. There's a long run-in. So essentially with a PPA, it goes against, you're securing a loan basically. So it can be open to credit, it can be open to scrutiny, there's lots of paperwork, it can take a while. So you might be looking at a 6 to 12 month run-in, if you were signing agreements today for these PPAs, which aren't going to help you in the short term avoid the inflated energy market prices. Whereas with a self-funded solar option, you might be able to start benefiting from that in 2 to 3 months time from the point of signature. So you start benefiting within year. With solar PPAs, the funded options, particularly the investors that we work with, one nice added benefit is that they don't invoke a take or pay clause. So you have flexibility. With a lot of PPAs, you set how much energy you're going to consume or take from that array in the contract, and you pay for it whether you use it or not. With the investor that we're using, which I guess is I think they're called Zestec, which people might be familiar with the brand name Octopus. They offer a zero take or pay clause, so you've got a lot more flexibility. Any questions on that? We've come on to Q&A section now anyway, so I will stop sharing my screen so I can see everyone. I'm not operating blind.
Anybody, if you just want to unmute yourself, and if there are any follow-up questions, ask now. No, looks like Everything has been
I've covered
by
most
you.
in the session, yeah, which is good.
I'll launch the next poll. Okay, can everybody see that? There are 3 questions in total. And then a copy of the slides can be sent out to delegates as well.
Absolutely.
Yeah, we'll get
Yeah,
that.
I'll send them over to you, Annette, if you can circulate with the members afterwards.
Yeah, that sounds. So yeah, everybody's answered the question.
Yeah.
Now, so I'll send a follow-up round as well.
Just as well, if anyone thinks of any questions or has any general queries about anything that we've covered today or any other energy or carbon challenge, we do have a dedicated inbox for Make UK members, which I can drop in the chat and Annette can share with the slides. It's makeuk@inspiredenergy.co.uk. So if anyone thinks of any questions or is a bit shy of putting the hand up in a group setting, chuck your question into that inbox and one of the team will pick that up and come back to you as soon as we can.
Our colleague Brigitte also just put a comment in to say that I know that some companies are offering the installation equipment up front, then getting paid back by the energy provider itself. Do you know this kind of option?
Yeah, I would always say if you have the money to make the investment yourself, do so, because the paybacks are so quick at the moment. If you're looking at securing investment for it, you're inevitably paying interest. And if you're contracting with a company that's going to take all of the risk in investing up front and then take it back through a share, there's got to be a lot of risk associated with that from their perspective, and therefore they're going to want a handsome payout in return. So I think if you look at those models and calculate them out over the lifespan, what you actually pay is a hell of a lot more than if you'd invested yourself or looked at a PPA option. But yes, there are options available for that.
Right. I think that's it then. You're getting lots of compliments and thank yous for a brilliant session.
No problem.
Great.
Thanks, everyone.
Right then. Thank you so much. And look at that.
Cheers.
Time. See you later, everybody. Take care.